Welcome to Bank Director's online training series and the second part of the Bank Regulation Unit. My name is Jim McAlpin, and I'm a partner in the Financial Institutions Practice Group at the law firm Bryan Cave in Atlanta. In the first video on regulation, I provided some foundational information on how the banking industry is regulated, including the role of the board in the regulatory process. In this video, we'll dig deeper into a variety of important regulatory issues, including an overview of the latest regulatory developments and some best practice recommendations that your board might want to consider adopting. I want to start out by reminding you of two very important points that I made in the first video. First, always keep in mind that the regulators expect every bank board and every individual director to be fully informed about the condition of their bank. In the eyes of the regulators, you are the first line of defense. And second, it's important to understand that bank regulation is a dynamic process that changes over time. Today, the regulators are placing a great deal of emphasis on capital, risk management, consumer protection, and compliance with anti-money laundering laws. 5 or 10 years from now, the emphasis could be on a different set of regulatory issues, which is why you need to stay abreast of developments in the industry and evolving regulatory priorities. Over the years of my involvement with the banking industry, I've been impressed by the genuine spirit of service to their communities that exists among most boards of directors. The fees paid to directors at most banks in the United States are modest. No one I know is growing wealthy from serving on the board of a bank, particularly a community bank. When I ask bank directors why they serve on a board, I most often hear answers along the lines of, to help guide the bank in its mission to serve the community, or to help ensure the bank remains strong. I admire this perception of the bank as being a vehicle to serve the community. Service on a bank board can be a rewarding and enjoyable experience. I've had some of the best biscuits and barbecue of my life at board meetings of community banks in rural communities. And I've also heard some great stories. Service on a bank board has many intrinsic rewards as well. It provides a window into the life of your community. And there is the satisfaction of knowing that the bank has made a positive difference in your community. Being an effective director means more than just knowing what's going on inside your bank and your community, however. It also requires an understanding of the major trends and events, beginning with regulation, that are shaping the banking industry. As I mentioned in the first video, I see a similarity between the banking industry and a football game. Each fall, I watch a lot of college football. And I have noticed how much the approach taken by the referees can impact the tempo and sometimes even the outcome of a football game. There is a noticeable difference between games when the referees are aggressive and throw a lot of flags and games when the referees are more passive and throw fewer flags. Over the past few years, the referees in the banking industry, the federal and state regulatory agencies, have been throwing a lot of flags. This regulatory activity has clearly impacted the tempo of the banking industry and continues to do so today. If you've been serving on a bank board for a while, you know that the tone and emphasis of bank regulation has changed greatly since the recent financial crisis. That was a traumatic event for our industry, for banks, and also for the regulators. It's worth remembering that the federal government had to take a series of extraordinary actions to stabilize the banking system and shore up the economy. I'll leave it to others to debate the appropriateness of some of those government actions, like the Troubled Asset Relief Program, the bailout of large financial institutions like Citigroup or American International Group, or the Federal Reserve Board's monetary policy of keeping interest rates low in order to help the economy. Instead, I want to focus on the regulatory landscape as it exists today and discuss what appear to be the most important developing trends in regulation. The regulatory agencies were criticized after the financial crisis for not reacting soon enough to some of the developments that contributed to the crisis, including the deterioration of underwriting standards, certain practices in the subprime mortgage market, and the high concentration of commercial real estate assets, particularly at community banks. If the regulators were too permissive before the crisis, they have tended to be overly cautious and conservative ever since, and today are quicker to criticize and generally much stricter in their interpretation of rules and regulations. I often hear community bankers complain that they didn't cause the financial crisis and shouldn't be punished for it. There's a lot of truth to that statement. But fair or not, the reality is that the regulatory environment is much tougher today than it was before the crisis. That places an additional burden on the board of a bank to make sure that effective compliance and risk management programs are in place, and that a philosophy of compliance and risk management excellence is shared throughout the organization. The rules of the game have clearly changed since the financial crisis, and much of that change is embodied in the Dodd-Frank Act, which was passed by Congress and signed into law in July 2010. Dodd-Frank is the most complicated piece of financial legislation ever enacted in this country. It is divided into 16 major sections. It covers everything from the orderly liquidation of financial companies and management of systemic risk to derivatives oversight and mortgage reform. It also requires the bank regulatory agencies to write 398 new rules. The full impact of Dodd-Frank has yet to be felt because today, 3 years after its passage, the regulatory agencies have written less than 40% of the required rules. The original timetable called for 70% of the rules to have been written by now. It was probably unrealistic to have expected the bank regulatory agencies, along with the SEC and the Commodities Futures Trading Commission, to have met all those original deadlines, especially given the complexity of the underlying issues that Congress attempted to address through the Dodd-Frank Act. But the Dodd-Frank Act will end up having a profound impact on the bank regulatory system once all of its mandated rules have been implemented, and these changes will require your board's full attention. I want to briefly touch on recent developments and regulatory trends that your board should be aware of in the areas of consumer protection, mortgage lending, bank capital requirements, the Bank Secrecy Act, and risk management. The one product of the Dodd-Frank Act that could end up having the greatest long-term impact on all banks is the Consumer Financial Protection Bureau. The CFPB is an independent agency within the Federal Reserve that was established to oversee consumer protection in the financial services industry. The CFPB has assumed enforcement and rulemaking authority for a long list of consumer financial laws that previously had been under the domain of other federal regulatory agencies, including the FDIC, the OCC, and the Federal Reserve. In addition to banks and thrifts, the CFPB also has consumer protection authority over credit unions, securities firms, payday lenders, and mortgage brokers and non-bank mortgage originators. The CFPB has direct supervisory authority over banks with $10 billion or more in assets. Shortly after its inception in July 2011, the CFPB began conducting on-site examinations of the largest banks to determine the level of their compliance with consumer protection rules. However, even if your bank is under the $10 billion threshold, it will still be subject to greater regulatory scrutiny in this area because the CFPB's active presence has forced the other regulatory agencies to place much greater emphasis and focus on consumer protection than previously occurred. The CFPB has been very busy on the rulemaking front as well and has issued a number of revised rules, particularly in the mortgage area. Because residential mortgages continue to be an important asset category for a large number of banks, including many community banks, your board should pay particular attention to two sets of revised rules. In January 2013, the CFPB made significant amendments to the Truth in Lending Act, otherwise known as Regulation Z. These changes establish a new set of requirements for lenders when they make ability to repay determinations during the loan approval process, and also define a new category of qualified mortgages that receive a presumption of compliance with those ability to repay requirements. If your bank writes a loan that meets the requirements of a qualified mortgage, it is presumed that the bank has already satisfied the heightened ability to repay determination. The intent of the new rule is to make it more difficult for unscrupulous lenders to make loans to people who can't afford to repay them. which was a widespread abuse during the subprime mortgage boom of the mid-2000s. During the height of the foreclosure crisis, an attorney from my law firm encountered a borrower with 5 homes in the same subdivision, all of which were being foreclosed on. Out of curiosity, my colleague engaged this gentleman in a conversation and learned that he was a middle manager from a retail store chain who had seen a great opportunity in residential real estate investment. When asked how he was able to obtain mortgages on 5 separate homes in the same subdivision, the borrower said that he had been assisted by a very ambitious mortgage broker. The mortgage broker had apparently advised the borrower that it was okay to check the box on each of the 5 separate mortgage applications, certifying that the borrower intended to use each home as his primary residence, because you never know which home could become your primary residence. Even though your bank wasn't involved in such abusive tactics, it will still need to make changes to its mortgage loan underwriting process as a result of the new rules. This will become an important compliance issue that the board will have to monitor. Also in January 2013, the CFPB made significant revisions to the rules on mortgage originator compensation. The purpose of these changes is to make it more difficult for mortgage lenders or brokers to steer people towards mortgages with higher costs or unfavorable terms that benefit the lender or broker at the expense of the borrower. Such steering was also a widespread abuse during the subprime boom. Your board will need to oversee management in its efforts to make sure the bank's compensation practices for mortgage originators comply with these new rules. These changes to the Truth in Lending Act were mandated by Dodd-Frank and will become effective in January 2014. The CFPB was established because of strong sentiment in Congress that abuses like predatory mortgage lending contributed directly to the financial crisis. Over time, I believe that consumer protection will become as important a regulatory imperative as safety and soundness, and your bank will need to have an effective consumer compliance program in place. Every consumer product you sell and every new consumer product you develop must now be viewed through the lens of this new regulatory emphasis on consumer protection. A good question to ask yourself in regard to every consumer product your bank has to offer is, would I sell this to my mother? Rather than, would I sell this to my mother-in-law? An even better question to ask might be, how would I explain this consumer product to the CFPB? Another important outcome of the financial crisis is the elevated importance that is now being placed on regulatory capital. There was a consensus in Congress and in the bank regulatory community that banks were undercapitalized and that this contributed to the 465 bank failures that occurred between 2008 and 2012. In July 2013, the Federal Reserve, the OCC, and the FDIC approved new requirements under the Basel III rules and also under Title 11 of the Dodd-Frank Act. Generally, most banks will be required to carry much higher levels of capital, and the types of capital that qualify for regulatory purposes are now more restrictive, particularly for large banks. Some of the more noteworthy requirements in these new capital rules include a new requirement for minimum common equity, higher ratios for Tier 1 capital and total capital, and also a new 2.5% capital conservation buffer that must be maintained above all of the risk-based requirements. The strictest capital requirements will be applied to the largest institutions, particularly the 8 largest U.S. banks that are viewed as posing the greatest systemic risk to the economy. Although many community bankers had hoped to be exempted from the new capital rules altogether, the rules ended up being much less burdensome on small institutions than what was first proposed by the regulators. For example, almost all banks with less than $250 billion in assets will be allowed a one-time option to opt out of the inclusion of accumulated other comprehensive income, which is basically income from securities gains or losses, in their regulatory capital calculations. The final rule also did not change the risk weighting applied to residential mortgage loans, as was once feared. and trust-preferred securities will continue to qualify as Tier 1 capital for bank holding companies with less than $15 billion in assets, which means the many community banks that have utilized these popular instruments won't have to raise new equity capital to replace them. The higher capital ratios will have a delayed effectiveness, beginning in January 2015 for smaller banks and January 2014 for large banks. When the final Basel III rules were released, the Federal Reserve estimated that 90% of banks with less than $10 billion in assets already met the new minimum common equity ratio, which was set at 4.5%, and the new capital conservation buffer of 2.5%, for a total of 7%. This reflects that many banks have raised their capital ratios since the financial crisis, either in response to pressure from the regulators or voluntarily out of their own sense of caution. When viewed in that light, the real impact of Basel III might not be that it raised the banking industry's level of capitalizations, but that it will prevent that higher level of capital in the industry from going back down as a result of balance sheet growth. As the crisis recedes further into the past, and as the U.S. economy improves, it would make sense for many highly capitalized banks to lower their capital ratios in order to improve their performance. It's a basic rule of finance. The higher the leverage, the higher the potential return of invested capital. But the banking regulators see it differently. From their perspective, the higher the leverage, the higher the level of risk. A fundamental change resulting from the financial crisis is that banks are now required by regulation to be more highly capitalized. Going forward, this will create a challenge as you and your senior management team strive to balance the desire of your investors for a competitive return on their capital with a strong government mandate for greater capital buffers in the industry. Another compliance hotspot that boards really need to focus on is the Bank Secrecy Act and related anti-money laundering statutes. This is not a new issue. BSA was enacted in 1970, and yet BSA compliance continues to be a major challenge for banks and a major point of focus for the regulators. Recently, the federal regulators have begun to look more closely at the BSA compliance of mid-size and community banks, as well as the large banks with international operations. Part of the problem is that the process of monitoring for suspicious transactions and patterns is extremely difficult because of the massive amount of data that has to be sifted through on a daily basis. In March 2013, Federal Reserve Governor Jerome Powell outlined the elements of an effective BSA compliance program in written testimony before the Senate Committee on Banking, Housing, and Urban Affairs. These elements include a well-developed and documented risk assessment that identifies and limits the risk exposure of the bank's products, services, customers, and geographic locations. Monitoring systems that identify and report suspicious activity. A strong training program that ensures that your personnel understand BSA regulatory requirements and bank policies. Independent testing to measure whether the compliance program is functioning properly. And authority given to a senior bank officer to ensure that all regulatory requirements and bank policies are being followed consistently on a daily basis. The board's responsibility is to make sure that management has put in place an effective compliance program and that the board is receiving regular updates on the bank's monitoring and compliance activities. It's very important in the current regulatory environment that you take BSA compliance seriously. Your bank's regulator will conduct a BSA compliance examination every 12 to 18 months. If you are a national bank supervised by the OCC, the BSA exam will now be included as part of the management rating in the bank's overall CAMELS rating. Comptroller of the Currency Thomas Curry has said publicly that when the OCC uncovers a serious deficiency in BSA compliance, it now considers that to be a safety and soundness issue. A significant BSA violation could prevent your bank from completing an acquisition, as M&T Bancorp discovered in 2013 when it tried to acquire Hudson City Bancorp. That $3.7 billion deal was put on hold after the Federal Reserve cited deficiencies in M&T's anti-money laundering procedures. and the bank was required to create and implement a comprehensive remediation plan to win Fed approval for the deal. If your bank does stumble into a BSA violation, my advice is to take it seriously and address the issue quickly. In January 2013, the U.S. Department of Justice and federal regulators reached a $1.92 billion settlement with HSBC Holdings over violations of a number of federal laws, including the Bank Secrecy Act. It has been reported that one of the reasons why HSBC received such a substantial penalty is that it failed to address the Federal Reserve's concerns in a timely manner. Regulators don't like it if you fail to address their concerns expeditiously. There is one additional regulatory hotspot I'd like to discuss, and that is the increased regulatory focus on risk management at the board level. You might be thinking to yourself, banking has always been an exercise in risk management. We take deposits in from customers and lend the money out to our borrowers. I would agree with you that making wise lending decisions is the fundamental risk avoidance tactic in banking. Beyond that, however, lies a myriad of other risks, such as IT systems risk, cybersecurity risk, employment practices risk, and fraud detection, to name a few, that the regulators are looking to the board to oversee. A full discussion of a comprehensive approach to risk management will be offered in Unit 3. But I can offer some practical advice from a regulatory perspective. First, make sure that someone in your bank's management team, other than the CEO, is charged with developing an overall understanding of the bank's risk profile and the elements of that risk. Second, have that employee report directly to the board on a regular basis. And third, direct that action be taken to address any developing areas of risk that the bank appears to have exposure in. These are three core elements of an effective risk management program that the regulators expect to see at every bank. You can't prevent risk, and bad things will occasionally happen. Your job as a board member is to ensure that there is a competent system in place for the oversight of risk management within the bank, and that there are adequate reporting lines into the board to advise the board of issues related to risk management. As we near the end of this video, a good summary statement would be that the board plays an important role in the regulatory process. I mentioned earlier that regulators see the board as the first line of defense. The culture of an organization begins at the top. It's your job as a director to make sure that the bank has strong compliance and risk management programs in place. Try to anticipate problems and rectify them, even if the regulators haven't criticized your bank for them yet. It's always better if you uncover a deficiency and fix it before it becomes a matter of concern for your regulators. The board also has an important role to play in maintaining an open and constructive relationship with your bank's regulators. I would recommend that you meet with them a couple of times a year for an informal discussion about what's happening in the bank and in the industry. It's also a best practice for the bank's chief executive officer and a few board members, including the chairman or lead director, to meet with the examiners prior to a regulatory examination to discuss the process and prepare for any issues that might come up. The strategy here is simple. Take advantage of every opportunity to have a constructive dialogue with your regulators and try to develop an attitude of trust and mutual respect, because it could pay an important dividend later. If a problem occurs, it will be more easily resolved if management, the board, and the regulators have already developed a good working relationship. As I bring this video to a close, let's go over some of the key points to remember. Always keep in mind that the regulators expect every bank board and every individual director to be fully informed about the condition of their bank. In the eyes of the regulators, you are the first line of defense. Bank regulation is a dynamic process that changes over time, which is why you need to stay abreast of developments in the industry and evolving regulatory priorities. Over time, consumer protection will become as important a regulatory imperative as safety and soundness. Every consumer product you sell and every new consumer product you develop must now be viewed through the lens of consumer protection. Banks are now required to become more highly capitalized, and this will create a challenge as you and your senior management team strive to balance the desire of your investors for a competitive return on their capital with a strong government mandate for greater safety and soundness in the banking industry. Thanks for your attention. And now let's move on to the next unit in the online training series, which will cover the board's role in managing risk.